If you don't know where to begin, better ask when.
Shane, good to see you. I'm glad we have a chance to talk today because I think people are feeling a little bit anxious about the market. So we're going to talk recession-proof investing, 4 strategies for navigating market volatility. But as I mentioned, the headlines are scary right now. What's going on?
Well, I think what we're seeing is a bit of a tariff tantrum where the markets aren't exactly sure what to think about the threat of tariffs out there. Who's going to get one? How great might they be? And in the end, what's going to happen, right? We're not totally sure yet. Combine that with some underperformance in the tech sector and the new administration as a whole making a lot of changes, markets are a bit off.
Right. And we can see that as we take a look at the S&P's performance.
Exactly. So this is the most recent 1 month. We see a lot of red, especially in those big tech blocks there. But if we switch this to a 1-year performance or the last 365 days, we can see a lot more green. And what this is telling us is just the reality that over the last year, the markets, the S&P 500, in fact, still up about 8.5% as of today, which means we're not by any means heading towards panic territory here. Things on average are still moving in the upward direction, in the right direction over a longer period of time, which is what we want to see.
All right, so I'd like to ask, a lot of people think cash is king during recessions. Are you recommending people allocate a larger portion of their portfolio to cash right now?
Well, the short answer to that question, Erin, is no, right? You want to make sure you kind of keep with the same amount of cash that you've always had, the same requirements that you've always had, because let's say you want to go to cash with half your portfolio because you're worried about what might happen here in the next 6 months to a year. That's the tough thing because you're trying to time the market. And timing the market is extremely difficult to do. When you try to time the market, you say, okay, let's go to cash now. We'll buy back in when things are right. But when do you do that? That's the real challenge. No one knows when to come back in. And if you don't do it at the exact right moment, it might be a matter of hours when you should buy back in. You'll miss that upswing and you'll be forever left in the dust, left in the past there. So time in the market is so much more important than timing the market. And a properly structured plan will account for some of these issues, some of these corrections, and have some cash on the sideline, but not too much cash.
Yeah, good point. I do want to ask you about defensive stocks, healthcare, utilities. We all still need to eat. We still get sick. What do you think?
Well, they can definitely be good during downturns, right? If we see the market heading down, like you said, we all have to take care of ourselves. We all need energy. We all have to buy food and the like. And a properly structured plan should account for some of these potential downturns and may likely include a lot of defensive positions that'll help take care of the portfolio in times like this.
Mm-hmm. And what do you think about dividend stocks or other fixed income investments like bonds?
Well, sort of similar to what we said about defensive stocks, a properly structured plan will likely have a lot of these things already inside of it that'll help balance out the portfolio if down times start to happen. Now, I'm not saying we're in a bad market condition at this point. We're far from a recession still at this point, I believe. But again, defensive things, dividend paying things, structured notes and the like that can generate income can be good, maybe even as you move later in life when you want to have a little bit more income from your portfolio. Mm-hmm. But lastly, a good solid plan, of course, again, will account for these things and will include defensive, like we said, as well as some dividend things, bonds, and the like.
And last, even during downturns, or especially during downturns, keep investing. This is known as dollar cost averaging.
You have to bring some consistency, some regularity to your investments, to your portfolio. And if you use dollar cost averaging, you can buy in at a fixed amount every single month, every single year. And that allows you to take advantage of averages. You buy in when things are low, you buy in things were high. And over time, you have a nice consistent price that you're paying for the shares that you're buying in. It brings a lot of consistency. And it's a great way to, over time, build up a nice portfolio.
Mm-hmm. And it all just comes back to what you're saying. When we have a financial plan, we are less likely to react emotionally to these headlines.
And that's what this is all about. Right now, if you watch the news, if you listen to what's happening out there, everything is extremely emotion driven. And if you have a plan, the plan is designed to take the emotion out of it. It's built to handle times like now. It's built to handle times when things are great, right? And it takes the guesswork out of things where you don't have to worry. You don't have to say, hey, should I go half to cash? Should I go half to this? Should I go half to that? Don't worry about it because a properly structured plan is already designed to account for these changes.
Shane, I'm really glad we got to talk this through. Maybe somebody would like a second opinion on their portfolio, or they would like your help building that financial plan. If they do, how can they get a hold of you?
Well, the best way to reach us, Erin, is online or via phone here at the office. Our website is winstonandcompanies.com. You can request to be contacted on there or call us here at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask when.